Hello all, this is study time. This is to prepare for the General Lines Life Accident and Health Life Insurance License. Let's talk a little bit about life insurance policies. Really short refresh about this topic. Types of life insurance policies. So you have insurance type, insurance life, really small insurances, $1,000 to $2,000, just paid weekly, nothing more. Group life, this is the one that you have in your company, place of employment association, coverage under a master contract. You don't have like a master contract. People, the employees receive benefits, a certificate. So it's not about a premium individual member. Ordinary life, separated by term and permanent, what we call whole life. So let's start with term life. Term life insurance gives you the greatest amount of coverage. It's good for a limited amount of period because that has a termination date. This is important. So that's the differences. So let's go. What's the deal? Like which types of term lives we have? We have three. They're like the major ones. Level term, also called premium level term, has a level face value, face amount, and level premiums. So premiums tend to be higher than annual renewable because they are level throughout the policy period. So level term has level face amount and level premiums. Premiums tend to be higher than annual renewable term because they level throughout the period. Let's go to the next one. Decreasing term. Term life insurance that provides an annually decreasing face value amount with level premiums. These are more for mortgage protection and for other products that you're gonna purchase. Credit policies. Credit policies are typically purchased using a decreasing term life policy with a term matched to the length of the loan period and the decreasing insurance amount matched to the declining loan balance. Since credit life insurance is designed to cover the life of the debtor and pay for an amount due on loan, if the debtor dies before the loan is repaid, credit policies can be purchased up to the amount of the debt or loan outstanding. Increasing term. Term life insurance that provide an increasing face value over time based on specific amounts and percentage of the original face amount. Convertible term. Term life policy has a provision that allows policies to convert their term insurance into permanent policies without showing proof of insurability. Convertible term provides temporary coverage that may be charged to permanent coverage without evidence of insurability. Renewable term. Term insurance that guarantees the insured the right to continue term coverage after expiration of the initial policy without having to prove insurability. Renewable term provides temporary level coverage at the lowest possible cost for a limited period of time, but allows the policy owner to renew the policy to maintain coverage past the policy's termination. So, annual renewable term. Term coverage that provides a level face value amount that renews annually. This type of coverage is guaranteed renewable annually without proof of insurability. Term rider. Term rider is a type of life insurance policy which covers children under their parents' policy. So that's a term like riders are just extra coverage that you can buy if like they're cheaper and you buy just and just works. Term riders can also allow an applicant to have excess coverage by adding additional term rider for them to the main policy. Whole life. Insurance that provides death benefits for the entire life of the insured. It matures at age 100 and normally has a level premium. Whole life insurance provides living and death benefits, provides permanent life insurance protection for the insured's entire life, and also provides living benefits such as cash value and policy loans. What's the positives? It covers the entire life of the insured, living benefits, fixed premiums. Protection more expensive, of course, and premium paid makes them beyond the incoming earning years. So let's work like what the differences, the interesting differences between whole life insurance. Straight life, straight up. Premium payments until death of insured or age 100. Limited pay life. Premiums are paid in a limited life. As premium payments period shorten, cash values increase faster and fixed premiums are higher. So you can just get your amount paid faster. Limited pay life. Single premium whole life allows the insured to pay entire premium in a lump sum and have coverage of insured's entire life. Single premium whole life. Modified whole life. Low premiums in the early years and jumps to higher premium in the later years and remain fixed. Premiums increase just once. Graded whole life. Under typical graded premium life insurance, the premium increases yearly in the stated number of years and then remains level. Premiums continue to stay level for the remainder of the policy. So then they go up until fifth year and then levels off for the remainder of the policy. So let's go back to what's the main ones. Straight whole life, limited pay whole life, single premium whole life, modified whole life, graded whole life. That are the major whole life insurance, major type whole life insurances. Special policies, family plan policies. Usually the family head is covered by permanent whole life insurance, and insurance are included in the same policy as level term life riders. So then the husband is a whole life, the spouse term policy, and the children term policies as well. This is important. Let's go like really slowly on this one. Differences between family income policies and family maintenance policy. Whole life family income. Whole life with decreasing term insurance. Provides monthly income to the beneficiary if death occurs during a specified period after the date of the purchase. So income of this typically decreases over time because household shrinks. So they have a whole life with decreasing life insurance. So this is the family income policies. The family maintenance policy is whole life with level term. Provides income to the beneficiary for the selected period of time if the insured die during that period. At the end of the income paying period, beneficiary also receives an entire face amount of the policy. So the income just provides just a certain income, monthly income to the beneficiary. The maintenance provides the income plus entire face value. So family maintains the family using level term. This means that the family will receive a benefit so many years after the insurance insures death. So that's the difference between family income, provides monthly income to the beneficiary, and the other one, maintenance, it maintains the person to that and pays also a face amount of the policy. This one, multiple protection policies, pays the benefit double or triple the face amount if death occurs during a specified period. So this is the multiple protection policies. If death occurs after the period has expired, only the policy face is paid. Joint life policy, a policy that covers two or more people. The age of insureds are average and the single premium is charged. If the permanent insurance it uses a permanent insurance as opposed to term and pays a death, only one insurance dies. So the survivors then have an option of purchasing an individual policy. The premium of the joint life policy is less than the premium for separate multiple policies. One policy covers two. Think joint accounts in a bank. One account, two people. Joint life policy. Juvenile insurance. Life insurance which is written on the lives of a minor is called juvenile insurance. A payout provision is attached to juvenile policies. It provides that in the event of a death or disability of an adult premium payer, the premiums will be waived until a child reaches a specified age. So in the juvenile insurance, someone is paying, someone dies, then you do payout provision on that to the person will be able to pay. Credit life insurance, designed to cover the life of a debtor and pay the amount due on a loan if the debtor dies before the loan is repaid. So let's go with some non-traditional life policies. Let's go. Interest-sensitive whole life. Interest-sensitive life insurance is the type of whole life insurance where cash value can increase beyond the state guaranteed if economic conditions warrant. So they call premiums can vary to reflect insurers changing assumptions with regarding to its death investment and expense factors. CAWL, current assumption whole life policies, are almost always a MAC due to accelerated premiums. So interest-sensitive whole life is a whole life insurance where cash value can increase beyond the stated guarantee. Adjustable life policies are distinguished by the flexibility that comes from combining term and whole life insurance in a single plan. So this one is really interesting. Adjustable life policies combine term and whole life in a single plan. The policy owner determines how much face value protection is needed and how much the premium wants to pay. Adjustable life insurance allows you to vary your coverage as your needs change without requiring evidence of insurability. Consequently, no new policy needs to be issued. So it's interesting because the adjustable life insurance is the flexibility that it has from term and whole life. So if someone asks about who has the flexibility of combined term and whole life, is the adjustable life policy. Universal life is the variation of whole life insurance characterized by considerable flexibility. Changes may be made with relative ease by the policy owner with these flexible premium policies. Unlike whole life, its fixed premiums fix everything. Universal life allows its policy owners to determine the amount and frequency of premium payments, which will adjust the policy face amount. So the universal life also has really big flexibility, the same way as you have in the adjustable life. Cash value accumulation subject to minimum interest guarantee, and any surrender charges on universal policies must be disclosed. Equity index life insurance, a permanent life insurance policy that allows policyholders to tie accumulation with stock market. MAC, a policy that is overfunded according to the IRS tables, is considered a modified endowment contract. Policies that do not meet the 7-pay test are considered MACs. and will lose favorable tax payments. The 7-pay test is a limitation on total amount you can pay into your policy in the first 7 years of its existence. The test is designed to discourage premium schedules that will result in a payout policy before the end of 7-year period. For example, if a year premium is 500, in a 7-year period, total paid will equal to 3,500. If you pay 3,501, it has now exceeded the 7-pay test and is no longer a life insurance policy. It will be now taxed as an investment. You gotta be careful when you do the 7-pay test. 7-pay test is the 7 years that you can make sure that it will have the favorable tax treatment. If we withdrawn prior to the age 59 and a half, 10% penalty. Taxation only occurs when cash is distributed. Funds withdrawn from MAC are subject to lasting first-out tax treatment. Penalty taxes on premature distributions from MAC normally apply to policy loans. Variable insurance policies. So you have variable whole life insurance was created to help offset the effects of inflation on death benefits. Is a permanent life insurance with many of the characteristics of a life insurance. The main difference is the manner of which the policy values are invested. So the base characteristics of a variable life policies are fixed premiums, guaranteed minimum death benefit with fluctuations over the minimum, and cash values fluctuate and are not guaranteed. So variable whole life insurance, the base characteristics of a variable life insurance are fixed premiums. This is important. Variable life insurance, that's a kind of catch, right? Variable whole life insurance has fixed premiums. Variable whole life insurance has fixed premiums. And minimum guarantee, minimum death benefit, which fluctuates, and cash value, which fluctuates, are not guaranteed. Variable universal life is the type of life insurance that builds cash value and combines all the characteristics of universal life and variable life. In the variable universal life, the cash value can be invested in a wide variety of separate accounts, mutual funds, and everything. So like VUL can be placed on mutual funds and all of that. So, and also the same thing with the variable life. They can be placed as well on mutual funds as well. The universal component in the name refers to the flexibility the owner has in making premium payments. So like it works with the universal life insurance. Like you have the flexibility to make the payments. This one, the variable component refers to the ability to invest in separate accounts. In the universal, it has the flexibility of the payments, the premium payments. And this is it for this chapter. Thank you and good luck. Have you enjoyed our content? Insurance Nation is a website a location that I created in order to find some content, in order to help you to pass the insurance, general lines insurance test. If you have enjoyed our content, please join us on YouTube. We'll always be able to just add more content down there. We'll be able to just provide some real examples, go to websites, and at the same time, we want to hear from you. If you want to have any questions or something that you have some questions about the test or something that you'd like for me to place it on this website, please let me know. I will be glad to help you out. go to Insurance Nation at ideanation.com, and feel free to provide any kind of donation of any size. Thank you, and see you next time.